Welcome to lecture 5 of business taxation. In this lecture we are going to understand how to calculate tax amount on accommodation, where we would also see house rent allowance and the accommodation facility that is provided by the employer. And then we are also going to look towards the conveyance facility and conveyance allowance. So let's look at the contents of this lecture. Previously, we have seen the history of taxation, and then we discussed that there are different heads that are there in income tax law. Then we started the salary head, and now we are going to understand how do we calculate taxable income for different aspects. Like there are different rules regarding house rent allowance or conveyance allowance or medical allowance. Are they taxable or not? If they are taxable, then is the full amount taxable, or there is certain rule regarding that? So starting with the facilities provided by the employer. So there are different facilities that are provided by the employer, either in the shape of a monetary benefit or the physical facility that are being provided. For example, in case of house, either the employer would provide a house to its employees, or the employer may provide an allowance in monetary terms to the employee. So there are other facilities in addition to the housing facility. So we are going to discuss all these facilities one by one. So we would start with accommodation facility, and within accommodation we would see what if there is a house rent allowance, and what if the employer has provided the accommodation facility. And then we are going to look towards the conveyance facility. Again, within conveyance we would have the conveyance allowance. The employer can provide conveyance allowance, or the employer can provide a car or a car facility to its employee. In both cases, how would we treat or how would we calculate the taxes? So starting with the house rent allowance, remember within accommodation facility, within accommodation facility, we had house rent allowance, which allowance is provided in terms of money, right? When you get your salary, so your salary would include basic salary, right? There would be certain amount. Then it would include house rent allowance. We also call it HRA. Then you might get conveyance allowance. Then you might also get medical allowance, right? And so on and so forth. So we are going to discuss each of them one by one. So this is what allowance is. Allowance is provided in within your salary. It is the monetary benefit that you get from your employer. But sometimes they won't provide you house rent allowance. Rather, what they would do is they would give you housing facility. So we need to calculate the value of this housing facility and so on and so forth. But the idea is that for each kind of facility, there are two ways the employer can give you a benefit. Either they can pay you in monetary terms, or they can give you that specific facility. Same is the case with conveyance. Either they can give you conveyance allowance, which would be monetary benefit that you would receive in your salary, or they can provide you car facility. Similar is the case with medical facility. They can either provide you medical allowance, and what you can do is you can accommodate that medical expenses in this allowance. Or what the employer can do is they might say that they would provide you an insurance, medical insurance, health insurance, and that insurance facility would be from the employer side. or what you can do is you can incur the expenses, medical expenses, and then the employer would reimburse them. The idea is that for each kind of facility, there are two ways the employer can give you a benefit. Either they can pay you the money, or they can give you the facility. So similarly, in-house, first we are going to discuss the allowance, the monetary benefit that the employer will give you. So if an employer provides any accommodation allowance, right, not the facility, allowance, or house rent allowance, the whole amount so received will be taxable. So for example, if someone is getting 1 lakh rupees per year for house rent allowance, which we would call HRA, then the tax would be paid on this whole amount, right? It is not exempted from the tax income. So when we are calculating the taxable income, remember the whole idea is to calculate taxable income, right? What is the taxable income of an individual? Once we calculate the taxable income, then we would just apply the percentage according to his or her tax bracket, and we would calculate the tax amount. So the first calculation that we need to perform is taxable income, the total taxable income for a whole tax year. So when we are calculating this taxable income, we would add this HRA, this house rent allowance, in that taxable income. So let's have an example, and it would be more clear. So Mr. Sharif is working in the scale of 20,000-2,000-30,000. Remember, we have discussed this in our previous lectures. This 20,000 means the minimum of the time scale, right? So normally you would see this in some newspaper ads, in employment ads. And what this means is that the basic salary would start from 20,000. The yearly increment would be 2,000, and the maximum the salary can go is still 30,000. By the way, this is what we have already discussed. So Mr. Sharif is working in the time scale. His basic salary is 24,000 per month. So this is the basic salary. During the tax year 2019, remember, if I say tax year 2019, it means that it starts from 1st of July 2018 and it ends on 31st of June 2019. So this would be tax year 2019. So he received from his employer house rent allowance at the rate of rupees 10,000 per month. Calculate taxable income of Mr. Sharif. So when we are going to calculate taxable income of Mr. Sharif, we would start with basic salary. So basic salary is 24,000 per month. So there are 12 months. So the yearly salary, remember we pay tax on yearly salary or yearly income. So the yearly salary would be 2,88,000. Then we would add house rent allowance, and this house rent allowance is 10,000 rupees per month. So there are 12 months. It would be 1,20,000. So the total amount is 4,08,000. Now what is this amount? This amount is called taxable income. What does taxable income mean? It means the amount on which we would calculate the tax, right? So this is the amount on which we would calculate the tax. Okay, so the simple idea is that the amount received by the employer under the head of house rent allowance will be taxable. It will be included in the taxable income, and it is taxable. By taxable, we mean, when we say something is taxable, it means that we would have to pay tax on that thing. When we say it is not taxable, then it means we do not need to pay tax on that specific amount or that specific category. Okay, so let's move forward. So we have discussed house rent allowance, right? That was the amount that is paid. But let's just say if the employer didn't pay any house rent allowance, but rather they said that we would give you a housing facility. So in the case of housing facility, we do not know the monetary value or the monetary amount that should be included in tax. So let's see what is the rule regarding that. So if the employer provides a furnished or unfurnished, so in case of furnished or unfurnished, the rule is same. Accommodation, the following amount will be added in the total income of the employee as value of perquisites, right? Perquisite is the facility that is provided. So following formula, the formula that I'm going to discuss would be used to calculate an amount, and that amount would be added in total income to calculate taxable income. So what the formula is: first, the amount that would have been paid by the employer in case such accommodation was not provided. So for example, if the employer do not provide an accommodation, he would have to pay 10,000 rupees as an allowance. Then this is the first amount that we are talking about, the amount that would be paid by the employer if the employer do not pay us the housing facility. Then the second is 45% of minimum of time scale of the basic salary. Remember, I just discussed in previous slide what is the minimum of time scale of basic pay. So 45% of that amount. So let's just say basic pay is 20,000. So 45% of this 20,000 would be 9,000. So now we have two amounts. One is the amount that would be paid is 10,000 and 45% of the minimum of the time scale of the basic pay. The rule says whichever is higher. So in these both cases, this amount is higher, so this would be included in total income, and then we would calculate the taxable income, right? So there are two things: the amount that would be paid if the HR is not paid, house rent allowance is not paid, and the second point is 45% of the minimum of the time scale. We would calculate both the amount, and then we would choose the highest amount and we would add it to our income, and based on that total income we would calculate the tax. So in case if there is no time scale of the basic pay available, then we would use basic salary for computational purposes. Let's have this example. Mr. Sabir is working in the scale of the scale is given. At present, his basic salary is 30,000 per month. During the tax year 2019, Mr. Faisal was provided a house rent-free accommodation. Sorry, what this rent-free accommodation means is that he is being provided a house to live, right, by his employer. He was entitled to an accommodation allowance of 15,000 per month if this accommodation was not provided. So although currently Mr. Shabir is provided a house, a rent-free house, a housing facility by the employer, but in case if this facility was not provided, then he would have been provided 15,000 rupees per month. So now we need to calculate the taxable income. So let's have this slide. So first we would have basic salary. Remember, basic salary is 30,000 rupees per month. So that would be 30,000 into 12, and we would have 3,60,000. Next, we need to calculate value of accommodation facility. Within this, we would have two aspects. First one was A, amount if housing is not provided. So this is the first part. Remember, in previous slide it said 15,000 would be provided if house is not provided, housing facility is not provided. So 15,000 is per month. So that would be a total of 1,80,000 rupees. Then we need to calculate the part B, which is 45% of the basic salary, 45%. So this 45% of basic salary, the time scale of basic salary is 25,000. So 25,000. Remember, we need to calculate yearly amount, multiply by 12, multiply by 0.45. So we get an amount of 1,35,000. So which one of these two amount is higher? Obviously 1,80,000. So we just transfer this 1,80,000 to this column, and then we would add these two amounts. We get 5,40,000 rupees, and this 5,40,000 is our taxable income. The tax would be calculated on this amount. But just in case if basic time scale of basic pay was not provided, so we didn't knew what this information is, then we would use this amount to calculate this 45%. Rather than adding using 25,000, we would use 30,000 in this case, right? So assume in previous example, Mr. Shabir was entitled accommodation allowance of 7,000 per month. So instead of 15,000, if the accommodation allowance was 7,000 per month, then what would be this amount? It would be 84,000, right? So now which one is higher? 1,35,000. So instead of adding this amount, we would use this amount, right? And we would similarly adjust this value. So probably you have got the idea of housing facility and house rent allowance. Okay. So from tax perspective, there are two types of city. One is big city, and the second one is small city. And which city is included in big and small city is given in the income tax ordinance in the schedule. So simple you need to understand is that the rule of 45% that we discussed is we are assuming that the employee is in big city, right? If the employee is in big city, then we would use 45%. If it is mentioned that the employee belongs to a small city, then instead of 45%, we would use 30%, right? Okay. So for your own practice, what you can do is assume that in previous example, Mr. Shabir belonged to a small city and then recalculate his taxable income. Okay, so in cases in this book or in our video lectures, it is not necessary that in each example we would mention that the employee belonged to a big city or a small city. So for the purpose of our video lectures, we would always assume that the employee belonged to a big city if it is not mentioned otherwise, right? If it is mentioned that the employee belonged to a small city, then we would consider 35%. Otherwise, we would always assume 45% for our lectures. Okay. The next allowance is conveyance allowance or conveyance facility. Okay. So within again conveyance, we have either conveyance allowance or conveyance facility provided by the employer. So if conveyance facility is provided by the employer, it can either be for the only purpose personal use, or it can be for personal and official use, or the employer can acquire the conveyance or the car on lease. So we have four different aspects within conveyance, and we are going to look at each of this aspect uh, in coming slides. So first of all, if conveyance allowance is provided, that is, if instead of facility we are provided some monetary amount, so the whole allowance will be taxable, fully taxable. So in this case, Mr. Salim annual salary is 1,80,000. He is also provided 2,500 rupees per month as conveyance allowance. Calculate his taxable income, right? So in this case, we first write the basic salary again. So basic salary would be 1,80,000. Then we would add conveyance allowance, and that would be 2,500 per month into 12, and that would be 30,000 rupees, and the total amount would be 2,10,000. So this is our taxable income. So conveyance allowance is fully taxable. Remember, taxable means that we would have to pay tax on that amount. Next we have if conveyance facility is provided for only personal use, right? So it should be purely for personal use. 10% of the car's original cost will be included in taxable income each year. So whatever the original cost is, not the market value. Remember, there is a difference between market value and the historic cost or the original cost. Historic cost is the amount at which the car was purchased. The market value is the amount at which the car would currently sell for, right? So let's have an example. Mr. A's annual salary for tax year 2019 is 4,20,000. He is provided a car for his personal use. So now we know that it's for personal use. The car was purchased by the employer for 1,80,000. This is the original cost, historic cost. So to calculate the taxable income. So in this case, we would calculate the 10% of this 1,18,000. So first we would write the basic salary. Basic salary in this case is 4,20,000. For 20,000, and then we would calculate the value of conveyance facility. So that would be 10% of 1 lakh 11 lakh 80,000. So this amount would be 1,18,000. The total amount is going to be 5,38,000. This would be our taxable income. Let's move towards the next aspect, which is conveyance facility for both personal and official use. So in this case, a facility is provided both for personal use and for official use. So in that case, 5% of the car's original cost will be included in taxable income. Remember, in previous example, we used 10%. So instead of 10%, if it is both for personal and official use, then this percentage is going to be 5%. Okay, the last one is if the employer acquires the conveyance on lease, right? Remember what lease is. Lease is uh, an amount that is provided, or if an asset that is provided to the lessor by the lessee for some rent. So for example, this employer, in previous example, we thought, we assumed, or the information that we had been given was that employer purchased a car, right? Employer purchased the car, the company purchased the car and then gave it to employee for his personal or official, or personal and official use. But let's, in this case we are saying that employer didn't purchase the car, rather the employer got the car on rent by themselves, right? So the concept of lease is involved here. The employer, instead of purchasing the car, got it on lease. So in this case, the fair market value at the start of the lease will be estimated, right? Again, in this case, the term market value is used rather than historical cost is used, right? Because it is not necessary that when this employer is getting this car on lease, it is being purchased at that specific moment. Rather, the car might be old, and so we need to have the market value of that specific car. So the market value at which time? At the start of the lease. So if the car was leased by this specific employer, the company A, in 2015, then we are talking about the market value in that specific year rather than today's market value. In case of only personal use, 10% of starting market value would be calculated as taxable income. In case of personal and official use, 5% of starting market value. So for example, if the market value was 1 million, then if it is only used for personal purposes, then 10% of this 1 million. If it is used for personal and official use, then 5% of this 1 million would be taxable. Let's have an example. Mr. A's salary is 22,000 per month. He received commission during the year amounting 33,000. This is an additional information. Remember always that commission is always taxable, fully taxable. Right? He is provided a jeep by his employer for personal and official use. Now you know that it would be 5%. The car facility is provided rather than conveyance allowance. The employer took the jeep from a leasing company. So now you know he didn't purchase it, he took it from a leasing company at annual lease of 80,000. But this is again irrelevant information. We do not need to look at the annual lease. Irrespective of whatever the annual lease is, the fair market value of the jeep at the commencement of the lease, at the start of the lease, is 8,50,000. This is what we are concerned about. Okay, so let's calculate, solve this specific question. The basic salary is 22,000 per month. So annually it would be 2,64,000. Then the commission amount again is taxable, so we would add it to taxable income. This is 33,000. Then we have value of conveyance facility. So 5% of market value is 8,50,000, and this would be 47,500. So the total amount is 3,39,500. Sorry. So this amount is taxable income. We would have to pay tax on this amount. Okay, so that's it for now, and in next video we are going to discuss the medical allowance or facility, and the entertainment allowance facility, and then we would look into the provident funds.